The market has done an awful lot between then and today, and yet has done nothing at all, really, other than chop the hell out of you.
Yeah, before I turned it off because it was driving me nuts, the network was making great play today of the fact that we were hitting 2-month highs, which, just meant that we'd crept over where we were around early October, which, if you'll recall, history was when Mr. Buffett was throwing lots of money at Goldman Sachs and General Electric. All our problems were being solved. The last times, as you say, we've been out of the market for 2 months, but guess what? The market's done absolutely nothing except grind anybody who's playing it into little hamburger pieces.
Yeah, that's why we have cash. That's why we use cash. And that's why, as you and I discussed earlier today, sometimes it's really important just to stand aside, just not be involved, like a good poker player. There's a time to press it and a time to sit back. But the important thing for what we're doing, and I'm really, really find this extremely important, is that when we restart again and we're out of cash, we have a bigger stack to deal with if the trends naturally that we finally go back into are correct. We play with more money than the next guy. I was reading this guy Farrell, who does this lazy investment stuff, and he was boasting about how he was beating the market by 3%, by 3 percentage to 15%, and thought that was great. Well, when in fact he's down 30-some percent as opposed to 32% as opposed to 38% or some such thing. That's no good, because you're going to have to make almost twice that amount just to get even. That's what we're trying to avoid, is that kind of nonsense. But you have any thoughts about that?
Well, I think it's a theme we've picked up quite a bit. Relative performance is the mutual fund wretch's game. And if you want relative performance, go buy a mutual fund. You can probably find a few of them that are only down 30% this year. Congratulations, but good luck. That's a big mountain to climb to get back to even. So, as I say, that's a theme we've hammered before. And
that's true. The other thing that happened today, of course, is that bond markets started to sell off again, at least the Treasury market. But other markets were rallying pretty good in the bond markets. And I was noticing the emerging market bond ETF and the high yield bond ETF and the corporate bond ETF, which I'm looking at. Those are rallying in price while Treasuries are starting to fall. So those spreads are starting to narrow. But it's going to take a lot of rallying on their part and falling on the Treasury's parts in order to get even, back to anything normal. And I don't think the stock market can rally all that far with Treasuries still at, 2.25% or 2.5%? Where were they today? 2.5% about?
Yeah, so the 10-year was somewhere around there.
And they had, a week ago they almost hit 2% even, which is just unbelievable to me. So we got DeMark 9s on all of the Treasury market complex 2 weeks ago. It's going to take a while for me to even think of being short. Technically it's take a lot more work, but I think it's quite possible. Yeah. Find ourselves short over the next, say, month or two.
There's no question. There's a little more risk. Someone, made the point today that if the market keeps going the way it's been going since Christmas, we're going to be at new highs around the time of the inauguration. There's certainly, some sense that there is some risk appetite, slim as it may be, but you've had a lot of people banging the table over the last 2 or 3 weeks that values are compelling, that the bottom's in, that, the yields on good quality bonds have gone to quote ridiculous unquote levels. With the way, one of the interesting things that's going on is the way the Treasury's handing out money left, right and centre, to the extent that it wasn't good enough to give GMAC, $5 billion to lend to people who, want to buy those exciting GM cars that are sitting on the dealer floors. They also threw in another $1 billion so that GM could give it to GMAC so it could get its capital up to the required levels. So the way money is being handed out is is in a particularly non-punitive fashion. You know, the perception is, and it's being pushed by some very influential people, including associates of Bill Gross and their ilk, you know, this will eventually begin to work in the economy, and that there is the risk, you know, some of these highly indebted institutions will fail, is essentially being taken off the tables. You know, obviously you're going to see some of these, you know, you're seeing some of these bond prices rallying. You know, believe it or believe it not, but as a you know, personally, I'm going to be much more interested in what happens next week once everybody gets back to work and starts paying attention again.
Well, that is the bullish case. The bullish case is risk has been removed by the government, that nobody's going to fail. All this liquidity that's been pumped into the market, plus the Obama and stimulus plan and everything else, that 6 months from now, you know, employment's going to be back to full, and inflation will be contained, and all will be right with the world, and people are going to be doing great. Now, the way I look at it, of course, is from a technical perspective, you know, just trying to compare a market with another market. The 74-75 market scenario seems to be pretty much what I think could happen, which is we have a pretty good rally, I mean a very good rally, such as occurred in 1975, subsequent to the 74 low, and happened at the turn of the year. After that was over, from 76 forward, nothing happened for another almost 8 years until 1982 rally took off. But what really happened was, of course, the great commodity rally. The Fed is really going to be under a lot of pressure to know when to take the punch bowl away, as they say, and start raising rates, because they're going to have to front-run inflation problem.
And of course, when they were talking just before Christmas, one of the reasons that sort of, you know, has doubtless contributed to what we've seen in the last few days, they were very clear that they had no intention of taking the punch bowl away anytime soon. You know, and there's going to be, you know, more stimulus than you can poke a stick at over the very near foreseeable future. You know, it's all good, folks. Pile in.
Yeah. They don't care about war or what's going on with Israel and the Middle East, Pakistani troops and Indian troops on the border and all that other posturing that hopefully is that all that is. My goodness, there's still a lot of tensions in the world. Anyway, Greg, I think that will do it for us for this week. Folks, we'll be talking to you again next week, and thanks for being with me, Greg.
Thanks, everybody, for listening. Thanks to you, Dave, and we'll talk to you all next week.